All right, why don't we go ahead and get started? So once again, that is our new Instagram account. If anyone wants to follow us on Instagram so that corporate marketing doesn't take it away, I would appreciate that. But anyway, my name is Mark Lamonica. I look after the individual investor team for Morningstar here in Australia. And today we're going to talk about international investing, which is exciting, right? We can't go overseas or, to another state or, depending upon where you live, beyond 5 kilometers from your house. But we can talk about international investing. So we'll do that. But first, a couple of housekeeping items. So number one, anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. The other thing, of course, is that I would love questions. So please send any of them through. And for friends over in New Zealand, you can go under our website, morningstar.com.au, to get our FAP. And also, the New Zealand regulatory authorities would encourage you to go speak to a financial advisor if you would like personal advice. And finally, we're doing another one of these tonight, 6 p.m. Sydney time. So if anyone's interested in that doubleheader, come on out for tonight. If you don't have a registration for that, you can just email me with any other questions at mark.lamonica1@morningstar.com. And you can bring a glass of wine. I'm going to drink a nice Pinot tonight, hopefully, although it's hard to talk and drink at the same time, something I need to solve. But let's get into this. So once again, there's our Instagram account. We stream this live on Instagram, so you can watch on your phone if you're doing anything, if there's anything to do. But, okay, let's see if I can work the slides. Here we go, international investing, and that's me. All right, well, let's talk a little bit before we get into the slides. Let's talk a little bit holistically about why we would want to invest internationally. So Australians, just like everyone else, exhibit a lot of home bias. So home bias, of course, is the tendency to invest the majority of your portfolio in domestic equities. Now, the reason that you do that is because it feels safer and it feels more familiar. So, of course, investing in the companies that you hear about and see and go spend your money at every single day is oftentimes a little easier for people. Obviously, you're also attuned to what's going on here with the economy. Certainly understand the different ways that companies report, different tendencies we have here in Australia. However, investing internationally can provide a lot of benefits, and we're going to talk about some of those today. So we're going to talk about why you should invest internationally, talk about how you can invest internationally, talk about some of the things that I think scare people away. So number one, like literally, how do you do it? What are some of the fees, transaction costs, tax situations that you have to deal with? And then, hopefully I can answer anyone's questions. So we'll go back to the slide deck. Okay, first, just a little bit of primer about what we mean when we talk about the world of investing. So what I've done is I've taken this MSCI World Index. So basically, this is the index that it's a developed market index. So there are 23 developed markets in the world. Obviously, you can see a lot of them on here. And this is index a lot of the international ETFs or funds actually track. So passive ones and then active ones benchmark themselves again. So what you generally have is, or what you do have is you have this developed market index. Then, of course, there is an emerging market index as well. But if we just look at developed markets, so remember when we include all markets, of course, these percentages will go down. But if we just look at developed markets, what this index represents is 65% of it, more than 65% of it is in the US. And we'll talk about what that means in a second. You can see the different countries on here, but down at the bottom, we see Australia. So you see Australia is just north of 2% in terms of allocation. Now, nobody is suggesting that this should be your asset allocation as somebody who lives in Australia for your equity investments. But it is important just to keep in mind that Australia makes up a very small part of these global indexes. So let's talk a bit about what we mean by a small part and how this is actually decided upon and measured. So many indexes, most indexes are market cap weighted indexes. So basically what that means is the bigger the company, the more of the index it makes up. So when we sit here and we look at this world index, it is basically looking at of the global market cap. So what all the companies are worth in these 23 developed markets, what percentage of them are in each one of these countries. So that's what we're saying here. So we're saying of all the companies in the developed that are headquartered and trade in the developed countries in the world, 65% of that market value is in the US. So that's what we're talking about. And if we look at the largest company in the world right now, which is Apple, which is worth over 2 trillion US dollars, it is actually about the size of the Australian market, and actually a little bit bigger. So it just gives you a little bit of perspective. Now, none of this means that Apple should be worth $2 trillion or any of these companies should be worth anything, but it is just important to take a step back and look at what we are missing out on if we only invest in Australia. We're missing out on basically 98% of the global market cap if we don't go outside of Australia. And we'll go through some of the reasons and some of the things we run into. But one important thing to remember also is that if you live in Australia and work in Australia, you are, of course, very tied to the local economy. Your job, the business you work for, very tied to the local economy, your house, an investment property, anything that you have. So one thing to think about also is kind of diversifying your overall risk. So if all of your equity investments are also just focused on the local economy, that means that you're very, very concentrated. Then the last thing I would say is that there's a high correlation between the Australian stock market and the US stock market. So basically what it means is you wake up in the morning, you see what happened overnight in the US, very likely the Australian market's going to follow suit. The inverse is not true. So what that does mean, and we saw this during the GFC in Australia, what this does mean is that if US markets, if something goes very wrong in the US from an economic standpoint and the markets plunge, it's very, very likely the same thing will happen in Australia. So we saw that in the GFC, right? There were banks that were collapsing in the US, none did in Australia. US went into a pretty severe recession. Australia did not go into a recession, yet still the losses in the Australian market were pretty extreme. The opposite does not hold true. So I think a major recession, obviously this is speculation, but I think a major recession in Australia probably would have little to no effect on the US market. So it's also a way to think about diversification. Let's look at a couple other factors. All right, let's look at performance. Now, I don't like looking backwards at performance, of course, because what has happened in the past really has no bearing at all on what's going to happen in the future. But I did want to show this chart to talk about an argument that I often hear is I don't want to invest overseas because there are no franking credits. Now, that is true. You do get no franking credits for investing overseas. But if we go back and look at a 10-year return, so this actually is not a 10-year return because the ETF doesn't go back. But I looked at 3 different ETFs. So VGS, that is a Vanguard ETF that tracks this developed market. So basically tracks that index I was just showing. So VGX, we can see that global market's up 141% since 2014. VAS, that is a Vanguard ETF that tracks the ASX 300, so 300 largest companies in Australia. And then VTS is a Vanguard ETF that tracks the S&P 500 in the US. So you can see that Australia performed significantly below global markets in general, and even more significantly behind the US market. No amount of franking credits would make up for this. So we've gone back and we've looked at, and in a report that we recently published about franking credits and looking for 10 good opportunities, we went back and we think it's about 2% a year that you get from franking credits. Now that's pretty significant, right? But still, it does not make up for the fact that the US market has gone up 180% and the Aussie market is up less than 90. So something important to remember. Now, obviously, anything could happen going forward. We could be sitting here in 7 years' time and look at this chart, and it could obviously be the complete opposite. But just remember, as I've heard these franking credit arguments sort of repeatedly, just remember total return can outweigh any benefits that you're getting from franking credits. All right. So let's look at another reason why you should invest overseas. You should invest overseas because you get access to different types of companies. So what I've done is I've looked at, once again, VGS, so looking at this MSCI Global Index, and Vanguard Australian shares. So I've looked at the sector allocation, and hopefully a couple things should jump out at you here. VGS, 21% is in technology. So all these tech names that you're hearing about, and they're all the ones you've been hearing out because they're generally large US technology companies. We don't have similar equivalents in Australia. So you're only getting 4% of the index if you invest in VAS and the ASX 300. So you're missing out on a couple key sectors. So technology, communication services, large sectors that are very underrepresented in the Australian market. What are you getting? You're getting two things. You're getting basic materials and you're getting financials. So when we sit there and we'll go, our next slide, we'll go into the top 10, but you know what this stuff is, right? Big four banks, Macquarie, BHP, Rio. You are very concentrated investing in certain sectors here. Now, that of course does not mean that those sectors will do well or poorly, but think about some of the things that drive those sectors. So financials are pretty unique, just in the way that they respond to different interest rate levels. They're also very cyclical, so they tend to go along with economic cycles. Same thing with basic materials, right? So when the economy is revving up, people are building a lot, investing a lot. So those basic material stocks generally do pretty well, but very, very dependent upon commodity prices. And we've obviously seen some interesting stuff going on. We've seen all of the giant miners report incredible 6-month results recently, but we've also seen a huge plunge in the iron ore price, which is causing some impacts. All right, so let's look at the top 10 holdings. So once again, VGS, you can see the top 10 holdings on there. Generally, large U.S. technology companies. So Alphabet, that is Google. There's two different shares of stock. That's why they're both on there. Towards the end, of course, we see something a little bit different. We see JP Morgan, of course, a bank, and J&J, the pharmaceutical giant. We turn our attention over to Australia. So once again, you see this thing peppered with banks, of course, the miners. And one important thing to note that will be occurring very shortly is, or not that shortly, but soon, is BHP is going to jump to probably 12%, is what people are saying, of the local index. So what they're doing is they're dual listed right now. They're shutting down. They're listing in London, bring everything back to Australia. So you're going to see BHP, around 12% of the local index. So, at the end of the day, that's putting a huge percentage, more than a quarter of your money if you invest in ASX 300 in CBA, BHP, and CSL. Doesn't mean there's anything wrong with those companies, but it's just something to keep in mind. Whereas when we go overseas, we can see there are different types of companies on there. The other thing that's really important to note about Australian companies is they are more domestically focused than most other companies. So if we look at, and this is important because, of course, we are investing in businesses. And businesses, of course, get revenue from different places now that a lot of them are multinational corporations. So got a couple examples in here. So 60% of ASX 200 revenue comes from Australia. And if we look at the US, if we look at the S&P 500, only 40% of the S&P 500 revenue comes from the US. If we go over to the UK, we look at the FTSE 100 in the UK, 30% comes from the UK. So just remember that a lot of the companies on this list, so namely the banks, are very domestically focused here. That's what you're getting, exposure to the local economy. So where something is actually headquartered doesn't really matter anymore. What matters is where they actually get their revenue. But in this case, we do have very domestically focused companies. And, a good example of that we use for this, as an example, why it doesn't really matter where something's domiciled is Diageo. So Diageo is a, global liquor giant. So you sort of name a liquor, chances are they own it, and Guinness as well. And so they're headquartered in London. But if you go and you look at their report, so I looked at their annual report in 2018, and Great Britain isn't even part of their reporting breakdown. So the company makes 24% of its revenue from all of Europe and Turkey, 34% from North America, for example. So there are examples why it doesn't really matter where the company's domiciled. And what stock exchange it trades on, but it does matter where they get revenue, because that, of course, as a business owner, is what you care about. All right, let's talk about a couple of the risks investing globally. Then we'll start getting into these questions. All right, so let's talk a little bit about currency risk. So currency risk is, of course, a reason why people are worried about investing globally. So of course, no matter how you invest globally, and we'll get into some of the ways that you can, no matter how you invest globally, you are faced with, well, there are some ways out of it, but you're generally faced with currency risk. So what currency risk means is that not only are you concerned, of course, how the underlying asset does, and we'll walk through an example here, but you're also really concerned about changes in currency. Because when you invest overseas, twice you are making exchanges, just like going on a trip. When you're buying, you're exchanging your Aussie dollars for whatever currency you're buying in. Then when you're selling, you're exchanging whatever that currency is back to your Aussie dollars. So same concept of going on a trip. Depending upon how long that is, there can be large fluctuations that will impact the returns you get. So I wanted to use an example. I think it's a good example. So August 30th, 2014. So the reason I picked this was because it's the day I moved to Australia. But if the day that I moved to Australia, I decided I wanted to buy Microsoft. So Microsoft, of course, the global tech giant. So I would have gone and bought it for $45.43. So great. I'm spending $10,000 Australian on this company. So you see the exchange rate there. For every Aussie dollar I have, I'm getting about 94 cents back US dollars. So what does that mean? I buy 205 shares, got my Australian value, $10,000, $9,300 US value. So then we move all the way to June 12th. So this, of course, is when I did this example. So June 12th, 2020. So Microsoft has done very well during this time period. You can see it went up from $45 to $187 US. So that's great. I sell my shares. Then I start looking at the exchange rate, and the exchange rate has changed significantly. So now, or at that point, my Aussie dollar is only getting me 68 US cents. So you can see there's been a pretty big fall. So what does that mean? That means, once again, I have the value in Australian dollars, I have the value in US dollars, and you can see the differences in total return. So because the Australian dollar has fallen significantly over this period, I am getting significantly more returns, right? I'm getting 465% on my Aussie dollar, where if I look at US dollars, I only got 313%. So it's an example of currency and how currency can impact an investment. Now, people get sort of mixed up around how currency works, but very simply, if you are an Australian, you're investing overseas, you want the Aussie dollar to fall against that currency. So whatever currency you're investing in, you want the Aussie dollar to get weaker. So basically the opposite of what you want if you're going on a trip somewhere and you want your Aussie dollars to go further. So you want the Aussie dollar to fall. Now, how can you alleviate currency risk? And first, we'll talk a little bit about some of the different ways that you can invest overseas. So one way that is becoming easier and easier because of changes in brokerage platforms and things like that is, of course, you can buy direct shares. So if you want to buy Microsoft, you can simply go and purchase Microsoft. So pretty much every broker allows international trading. So whether you're with a bank-aligned broker like ComSec, whether you're into one of these more fintechy brokers like Stake, things like that, all offer international trading. Now, a couple important things to remember. You're going to pay a lot more in sort of the traditional, on ComSec, you're going to pay a lot more from a transaction perspective to trade overseas. There are things like Stake that offer free trading overseas, but they gouge you on the foreign exchange. So just if you are considering directly trading overseas, go and look at how they actually charge you. So Stake does charge you, for example, a lot to change your currency. You get the trade for free, but you're going to pay on that currency exchange. So that's one way to invest overseas. The other way, of course, is to let a professional handle it. So whether that's a passively managed ETF or fund or an actively managed fund that's investing overseas. And that, of course, is a lot easier for you to handle here in Australia. So with an ETF that's trading on the local exchange, you, of course, can just purchase that through your brokerage. With a fund, you can just, however you purchase funds, whether you're going directly out to the fund manager or whether you are or whether you're going off of a platform or through a financial advisor or anything else, you can purchase a fund. Now, what many funds have started to offer is a hedged version of the fund. So what a hedged version of a fund or an ETF that invests overseas, what that does is it removes currency risk. So if you are very worried about currency risk, then that's an opportunity for you to remove that from the equation. So then your return will simply be based on the underlying securities that that fund or ETF is invested in. So I do have an example. Looking at Magellan. So of course, Magellan is a very famous Australian investment manager that invests overseas. Two different versions of the exact same fund. So Magellan Global. For both of these, they're investing in the exact same companies, but there is a hedged version and a non-hedged version. So once again, hedged means they remove the currency risk. And I just grabbed returns. So this hedged version has not been around as long. But if you simply look at this total return category, you can see there are differences, in some cases pretty significant differences, and that is, of course, based on currency movements. So something to think about. Now, you do pay slightly higher fees on these. They're very, very small. So basically just transactional costs and operational costs. They are, I'm looking at Magellan now, like it's basically 0.1% that you pay extra. So it's not a big difference in fees, but just know that there are fee differences. And the way, of course, they hedge this is they use currency forwards to do that. So it is very difficult on your own to hedge your own investment, but you can go in there and do that. All right. Well, anyway, thank you guys very much for joining. I will be back in a couple hours. Thanks.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.